Good evening, everybody. Thank you very much for joining in. This is 51st in the series where we're going to speak about a topic which is known as hedging of Japanese yen and Canadian dollar. Well, from this side, I'm Rahul Magan, working as a corporate treasurer in EXL. At the same time, I'm working as a treasury trainer and business consultant in various firms across the world, predominantly in Asia and Singapore. I'm also acting as a virtual treasurer for various companies in India. You're most welcome to join my Foreign Exchange Academy, which is known as Foreign Exchange Memory Thinkers, on LinkedIn, YouTube, Dailymotion, and Facebook. LinkedIn covers roughly 2,200 members, YouTube covers 50 technical videos, 1,280 views, and 45 subscribers. Dailymotion covers 35 technical, and the Facebook, which is a newly created page on Facebook of Foreign Exchange Memory Thinkers. Well, today we're going to speak about a topic which is known as hedging of Japanese yen and Canadian dollar. In the last few weeks, the last few trading sessions, the world saw a sudden volatility in the currencies, and the two currencies where basically the two sets where we saw the huge volatility is known as G7 sets, and amongst G7 one set which is known as commodity currency. So predominantly speaking, we have saw big volatility in euro thanks to Scottish referendum. We have saw in the GBP thanks to Scottish referendum. Then we saw in the Japanese yen. And one more where we saw a huge volatility which is known as commodity currencies. Now, today Euro is trading at roughly 1.25 levels. Japanese Euro is trading at 1.25. GBP is trading at 1.62. Japanese yen is trading officially touch 100. And amongst commodity currencies, Canadian dollars touch 1.12 and Aussie dollar touch 0.87. Today we are living in a world when majority of the times we have saw that currencies are playing a very big role. Example, currencies are turning very volatile and they are even losing or gaining one or several big figures in a day. Now one big figure refers to 100 basis point. So if a stock moves from 1.6 to 1.61 or 1.60, then it is lost one figure. Here he lost two big figures. Or if it goes to 1.63, 1.65, here he gained one big figure, here he gained three big figures. Today stocks are losing today the currencies are losing like anything. We have saw in the case of Japanese yen, which was trading roughly at 98 or so, today it is trading at 110. And now the prediction is that it will cross over 125. The purpose of the today video is to let you know, if you're acting as a Japanese treasurer, then how you should hedge your receivables and payables when the currency is trading at 110, officially touch 110. Or if you are acting as a treasurer in Canada, then your currency is trading at 1.12, how will you take care of that? Well, as earlier discussed, we are living in a world when currencies are turning highly volatile. So it is predominantly important for you to understand that you should hedge your receivables and payables using option contracts. You should not hedge your receivables and payables using forward contract, because the time of forward has gone. They are the simplest and the plain vanilla instrument which holds no value in the system. You should hedge via option, and in options is of two types, which is basically like that. Options is of two types. One set of options is the plain vanilla options. So if you are an exporter or you are an importer, if you are an exporter, you would like to go with the buy put contract. If you are an importer, you will like to go with the buy call contract. On the other hand, which is together they will known as plain vanilla contracts. On the other hand, if you are a person, if you are a corporate treasurer who want to go little aggressive side, however you want to go with the options, then you go with the cost reduction structures. Sometimes traders refer to this as exotic options also. Then you should do with range forwards, and you should do via Seagull. You can also do the same via call spread, via put spread, via condor spread, butterfly, and respective others. Please be note that it is predominantly important for you to hedge your receivables and payables using these kind of option structures, because time has gone when we have to hedge our receivables and payables using so-called plain vanilla forward contract. Option is nothing but an instrument which will give you a right to buy or sell. Now take a very simplest example of option contract. We're going to take a very simplest example how a Japanese treasurer is going to save himself via an option contract vis-a-vis a forward contract. Or we'll take an example of we'll first take an example of a Japanese treasurer, then we would like to go with an example of a Canadian treasurer. If a Japanese treasurer who is having dollar receivables and JPY cost, so for him he would like to do put dollar. Now put dollar means what? Call JPY. Put dollar means selling dollar and buying JPY. Now today JPY is turning out to be 110 for a simplistic note, and if 1 year forward premium is roughly one big figure, if not one big figure, assuming 1 year forward contract is turning out to be say 109, because JPY is turning out to be discount, then if he is going to book a forward contract for Japanese, then it is going to be 109. So after 1 year, if the price of a contract would go to say 115, 110, 107 and 103, then here he would have gain, here he would have gain, here he would have loss, and here he would have loss. On the other hand, if it is going to book a contract which is known as buy put, now this is something at the money forward he is having right now, and rather than booking at the money forward, because 1 year Japanese currency is trading at 9.1 year Japanese yen is trading, 1 year volatility of Japanese is at 9.5%. So rather than booking a plain at the money forward, he should do out of the money forward. So he is selling, so he should do roughly 106. In that, if any of the four would happen, he would either exercise or he would let it worthless. The same would go with an example of a Canadian dollar, which is roughly trading at 1.12 levels right now, and if he is going to book it, then he would get a price say 1 point, because it is trading at discount, he will get 1.10. However, if we do an option contract, then he would be able to save himself from any kind of thing. The purpose of this video is to let you know that today we are living in the times when we have to, rather than buying and selling in option contracts, we have to shift from simplistic option to range forward. So for a Japanese treasurer, rather than doing a simple put contract, what he should do, he should go ahead with a range forward, which is like that. So rather than selling, he should do like that. He should do range forwards, and he should do exporters. So he should do buy put, where he would pay the premium, and he should do sell call, where he would receive the premium. Net it would be a zero cost. So you are saved here. This is known as market, and you are saved here. Here you have a little bit of loss, because here you don't have the right rather than obligation. So please be, and here you would have a substantial gain. So rather than doing a plain vanilla forward contract, people should do an option contract, and in two option contract they should do range forward contract. Try and understand that today companies are running on a margin of not more than 10 to 15%, and if we continue to book continue to hedge our currencies in that way, then we are going to be nowhere. So it is very much important for us to understand that option play a very, very important role. And as a corporate treasurer, I would like to recommend that rather than booking option contracts in the deliverable market, treasurer should think to do option in a non-deliverable market. So you should, rather than doing this so-called range forward, you should also do, rather than doing in a deliverable market, the corporate treasury policy should be such that you should do in the non-deliverable market as well, which is like that. So you should not only do in your deliverable market, but should also do in the in so-called non-deliverable market as well. At the end, I would like to stress the fact that keeping the fact that today currencies are running at a 1-year volatility of majority of the currencies, G7 commodities and all running roughly 9.5% to 10%, it is predominantly important for us to understand the fact that we should hedge our receivables and payables using an option contracts rather than a forward contract. And in option contracts also we should do via range forward contracts. And in range forward too, we should try and do via both, which is deliverable market and non-deliverable market. Please be note that time has come when corporates have to amend their risk management policies, which would cover not all type of option but deliverable and non-deliverable as well. You are most welcome to contact me at 919899242978. You are welcome to email me at Rahul Magan 8@gmail.com. Before leaving the show, I would like to again stress that the time has come when we have to amend our risk management policies because the biggest news one is on the way. Thank you for that.